Welcome to another episode of the Tax Blueprint, Structuring Funds, Joint Ventures, and REITs. This is the last in our three-part series exploring the advantages of the use by funds of REITs for different groups of stakeholders. In the first two parts, we covered benefits to U.S. individual investors, U.S. tax-exempt investors, the GP stakeholders, and that leads us to today's episode where we are covering foreign investors. I'm Saba Ashraf. I'm joined once again by Aresh and Tom Phelan. We are all members of the tax group at Taunton Pepper Locke. So as I said, the focus today is on foreign investors. Foreign investors are a significant source of capital for U.S. funds, including U.S. funds that target investments in U.S. real estate. And we'll walk you through the advantages that REITs can offer for attracting this source of capital. Turning generally to the goals of foreign investors, as a general matter, not for every investor, but generally, foreign investors investing in funds would like to, one, minimize U.S. tax return filing obligations, and two, to the greatest extent possible, minimize U.S. tax liability. With these goals in mind, I'll turn it over to Tom to describe the U.S. taxation of foreign investors in general. And after that, we'll turn to comparing the tax to them under different forms of investment using regular C corporation blockers and REIT blockers. Go ahead, Tom.
Just setting the stage on the general U.S. taxation of foreign investment into the U.S. Generally speaking, a non-U.S. investor is subject to tax in the U.S. in situations in which Congress has determined there's sufficient nexus or connection to operations in the U.S. that warrant U.S. taxation. The primary distinction between the kind of two major types of taxation and the nature of the nexus that results in that type of taxation are, one, taxation when a foreign investor is treated as engaged in a trade or business in the United States, and the second being when that U.S. investor is making more of a passive investment, portfolio type investment that generates what we call FDAP, or fixed and determinable annual or periodical income, which is stuff like interest, dividends, stuff to that effect, which usually is indicative of a lower level of connection to operations in the U.S. Very generally, distinction is that if you're engaged in a trade or business in the U.S., then a foreign investor is generally taxable on their income on a net income basis at graduated rates, just like as a U.S. taxpayer would be. And they're generally required to file a U.S. tax return, being federal, state, and local as well. For portfolio-like investments, like an investment in a stock issued by a U.S. corporation or debt issued by a U.S. corp, generally they're taxed based on the source of the income and are subject to withholding when that income is paid out, right? The U.S. corp pays a dividend subject to withholding. So with respect to whether someone's engaged in a trade or business in the U.S., the discussion is really kind of well beyond the scope of this podcast, but it's very much a factual question, depending on the kind of nature of the business contacts that the person has with the U.S. and looking for particularly continuous, systematic, and ongoing contacts. There's special rules for employees and independent contractors, depending on where they're located, but it's a facts-based thing. Notably, if you're engaged in a trade or business in the U.S., or if you invest in a partnership that's engaged in a trade or business in the U.S. as a foreign person, then the kind of active trade or business of that partnership is imputed up to the partner. Generally, that's not the case if you invest in a corporation, which can serve as a blocker, and we'll talk about that a bit more. For portfolio-like investments, like investments in stock and owning debt, other things like royalty, they create FDAP income. Again, that's generally taxed through withholding. I think we mentioned that, right? If you own stock in a U.S. corporation and it pays dividends to a foreign shareholder, those dividends are U.S. source by nature of the fact that it's a U.S. corporation that's paying the dividend. That's sufficient nexus to the U.S. to kind of warrant taxation and is generally subject to a 30% withholding tax, subject to things like treaty reduction and also FATCA status of the holder. If you hold stock in a corporation, generally speaking, and you're a foreign investor, the disposition of the stock, the sale of the stock, typically is taxed sourced to the resident of the selling party. So if you're a foreign person and you sell stock, you're generally not subject to tax because it's foreign source income, and it's just entirely not subject to U.S. tax unless for some reason that capital gain is effectively connected with the U.S. trade or business. When it comes to investment in real estate, there are certain special rules. A rent earned from a real estate investment is generally subject to the same rules that we discussed before with respect to classification as effectively connected income, if it's associated with the trade or business, or FDAP, if it's just kind of rent received from a U.S.-based property. But there's special rules with respect to the disposition of U.S. real property interests. And generally speaking, those rules fall under what we call the FIRPTA rules, and they treat gain from the disposition of a U.S. real property interest as effectively connected income for tax purposes. So this means that even portfolio type like investments in U.S. real property can be subject to U.S. tax on disposition. So what is the U.S. real property interest? Generally speaking, it's just any real property interest that's located in the U.S. If you own a building or a mine or anything else that's classified as U.S. real property. Notably, interest in U.S. real property holding companies are also U.S. real property interests. So a U.S. real property holding company is a domestic corporation where 50% or more of the total value of its assets are U.S. real estate assets. So if you own an interest in a U.S. real property holding company and you sell that stock, generally a foreign person wouldn't be subject to tax on the sale of stock. But if it's a U.S. real property holding company, under the FIRPTA rules, they are subject to U.S. tax on the gain from the sale of the stock, and that tax is generally collected via withholding. With that general background, I'll pass it over to Saba to talk about how this applies in the context of REITs.
Thanks, Tom. We thought it might be helpful for Aresh and I to walk you through an investment structure where the fund is using C corporation blockers to make the investment in real estate, and alternatively, where it's using a REIT to make the investment, and the difference in tax treatment to the investors, to the foreign investors. Now, I will say that there may be foreign investors that have come to the conclusion that they're fine with investing directly in a fund that doesn't have any blockers. It may be that a foreign investor perceives that due to significant upfront deductions that are often associated with real estate investments, there will be no taxable income in the early years, and they think it's just fine. It's in line with their planning, and they don't mind being subject to U.S. tax on a net basis and filing tax returns. So in that case, they can always invest directly in a fund without having any blockers. That's all fine. We're not addressing that. We're focused on foreign investors that are seeking to minimize tax return filing obligations and be blocked in some fashion. So Ash and I are going to focus on, I think it's helpful to think of the tax treatment for three different types of income that would be generated by the fund. One is dividends attributable to operating income, like rents. The second is dividends attributable to the sale of real property, like capital gains dividends by REITs. And the third is gain from the sale of either the stock of the blocker or the shares of the REIT. So turning first to dividends attributable to operating income, like rental income. In the case of a C corporation blocker, the C corporation would pay 21% tax on its operating income. And maybe this corporate tax is reduced by deductions. Maybe it's reduced in part because the C corporation blocker is a leverage blocker, capitalized partly with debt and partly with equity. But there's that 21% tax rate. And when the dividends are paid by the C corporation to the fund and in turn to the investors, including the foreign investors, the dividends would be FDAP and subject to withholding. If there's no treaty in effect, the withholding would be 30%. Often with treaties, the rate is reduced to 5 or 15%. In the case of the REIT, if the REIT is used as the blocker, the tax consequences would be very similar. The dividends, to the extent of earnings and profits, would also be considered FDAP and be subject withholding at a rate of 30%, again, often specifically reduced for REIT dividends by treaties. Turning next to the next stream of income would be dividends attributable to capital gains. So these would be dividends that are made either by the C corporation or the REIT from gain from the sale of property. So in the case of a C corporation blocker, the result would be very similar to the tax treatment of other dividends, FDAP withholding. One key difference might be, in the case of a C corporation, is that if the C corporation is liquidating as part of that final distribution, in other words, let's say it was a single property C corporation blocker, it sold its property and now it's going to liquidate. In that case, the dividend would not be subject to withholding because liquidating distributions are generally not subject to withholding. You're still dealing with the corporate level taxes payable by the blocker, which again may be somewhat reduced. Now, if the dividend were made by a REIT blocker, the foreign investors and the fund would still be subject. They would be subject to U.S. federal income tax and federal income tax filing obligations for those capital gain dividends. So the REIT does not provide a great advantage here. If the dividends are, if they're going to be capital gains at the REIT level, and then they're going to be distributed to the foreign investors. Gain from the sale of shares of either the C corporation blocker or the REIT, there can be a marked difference here in the tax treatment to foreign investors. In the case of a C corporation blocker, the gain would be considered gain from the sale of a U.S. real property holding corporation, which, as Tom described, would be subject to U.S. taxes generally collected by withholding via FERPTA. And then I'll turn it over to Aresh to discuss REITs.
In the case of a sale of stock, one of the main benefits for offshore investors is having a REIT in the structure, because if a REIT is what we call a domestically controlled qualified investment entity, then the sale of the REIT stock is not going to be subject to FERPTA, which is, a significant benefit for offshore investors. And a REIT is domestically controlled for these purposes if less than 50% of its stock is held directly or indirectly by foreign persons, at all times during a certain testing period, with the testing period basically being a 5-year period up through the date of the disposition. So that's a really big benefit, is that, without a REIT, with just a blocker, a C corporation blocker in the structure, sale of stock is going to be subject to FERPTA. Whereas if there's a REIT in the structure and the REIT is domestically controlled, then there's going to be an exclusion from FERPTA. Again, a big benefit. And because that benefit is so significant for offshore investors, a lot of times REITs that think that they're going to have a significant offshore component will include transfer restrictions in their organizational materials, such that transfers that could result in a REIT not being domestically controlled are going to be precluded. And so by doing so, that's one way to ensure domestically controlled status and therefore making sure that sales of stock are not going to be subject to FERPTA. And for years, that was the position that we were in. And, everyone was really, frankly, happy and content about it. And in 2023, the Treasury Department threw a curveball to all of us, because they issued proposed regulations that generally required REITs to look through non-public taxable domestic corporations and determining whether a REIT is domestically controlled. And that was in 2023. And at the time, as part of the proposed regulations, the look-through threshold was 25%. And so, relatively low threshold. And if you had 25% offshore investors in a blocker entity, then those would be included as part of determining whether you've got a domestically controlled REIT. And the issue is that a lot of REITs and JVs and real estate funds, they specifically engaged in tax planning with blocker corporations comprised predominantly of offshore investors to make sure that they did have a domestically controlled REIT. And so when these rules came out, they were heavily criticized, mostly because most people, including myself, thought that they were inconsistent with existing tax law, and in particular, a private letter ruling that specifically said that you don't look through for those purposes. And the Treasury was urged to pull the regulations, and they did not do so. And instead, they bumped up the threshold from 25% to 50%, which is helpful. But again, in cases where you're using blocker corporations for purposes of ensuring domestically controlled status, usually 25 to 50% isn't going to make that much of a difference for planning considerations. So that remains an issue, and there's a lot of work and attention being paid to it. But the final regulations also did include a transition rule. And under that transition rule, REITs were exempt domestically controlled REITs were exempt up to 10 years if they met certain requirements. The requirements It's a very helpful transition rule, but some of the requirements have to do with the amount of assets and control changes. And as a practical matter, again, less than ideal. So, this issue remains a work in progress. If you're in a situation where, you're not engaging in specific tax planning and using blocker corporations, then, having a domestically controlled REIT and, the standard practices with respect to that are going to continue to be helpful. But for those real estate funds and JVs that are using blocker corporations, I think that's something that, people are really looking at closely and thinking about ways to fall within the transition rule.
For foreign investors that are investing in REITs, Aresh already described this, but they will want to require the fund, one, to not only ensure that their REITs are domestically controlled, but also to exit through the sale of REIT shares rather than, a sale of the underlying property. For the sponsor or the GP, the important thing to remember there is that one REIT holding all the property is not going to serve the foreign investor's goals unless the REIT is able to sell all the properties to a single, or the REIT has a potential buyer that is interested in purchasing or agreeable to purchasing all of the property. If that doesn't exist, then to achieve the foreign investor's goal will require essentially single property baby REITs. So that's just a quick note as to special rules that apply to particular types of foreign investors. There are generally more favorable rules that can apply to foreign governmental investors under Section 892 and qualified foreign pension funds. Qualified foreign pension funds, which are basically foreign funds established to provide retirement or pension benefits to current or former employees. They don't have large beneficiaries, and they're subject to various forms of regulation and reporting. So for them, they are exempt from FERPTA. Therefore, they will not be subject to U.S. tax on REIT capital gains dividends or on the gain on the sale of a U.S. blocker or U.S. REIT. They will, however, be subject to FDAP withholding on ordinary dividends from a blocker or a REIT. And as to foreign governments, they can qualify for complete elimination of withholding on ordinary dividends and on the sale of the REIT shares, as long as the governmental entity does not control the REIT. They would, however, continue to be subject to tax on capital gain dividends. The podcast you just listened to was recorded a few days ago. Today, on October 20th, the Treasury issued proposed regulations that touch on one of the topics we covered, specifically the topic of domestically controlled REITs and how they offer particular benefits to foreign investors. Please do look at the advisory that we are simultaneously releasing. It is listed as a resource on this podcast page. It's titled Taxpayer Favorable Proposed Regulations Would Repeal Domestic Corporation Look-Through Rule for Domestically Controlled REITs. So as noted, they are taxpayer friendly. They do give more flexibility in qualifying as a domestically controlled REIT. So please do note that. Thank you again for tuning in to this 3-part series focused particularly on the benefits of REITs to all classes of investors as well as the general partner. We hope you will tune in to our next episodes and series where we expect to focus on numerous topics of interest, including structuring by funds and GPs to ensure maximum utilization of Section 1202, characterization of preferred equity investments, management fee waivers, and other topics of interest. Thank you again.
Copyright Troutman Pepperlock, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman does not make any representations or warranties, expressed or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepperlock. If you have any questions, please contact us at troutman.com.